Alrighty, well, let's start with the biggest economy in the world like we do every year. Looking at the US data, what did we learn? So looking at their GDP data that was released in January, we saw a 3.3% annualized result for the December quarter and a 3.1% actual quarterly result after a 4.9% annual rate for the September quarter. And that was much better than the consensus forecast of 2%. So what did you get out of that, Evan?
So what I get out of it is the soft landing, which we all keep hearing about, is absolutely on in the world's biggest economy. So it is really positive to see that overall GDP is still really strong in terms of what the longer term trend is. Don't forget, the US Federal Reserve basically says that if the US can average between 2 and 2.5% GDP growth, that's just above their what they call their neutral rate. So I take this as a really positive thing that they have managed their economy well. The GDP is moderating back to a much more realistic long-term level. And it goes, as I said, quarter on quarter, year on year, back to where they all need it to be so that they're actually not overheating, not undercooking. So that's my take. I think it's a really strong scenario that 2024 is going to be that year of moderation we need without it being a crash and a hard landing.
Yeah, so we know that's on the back of obviously the tightening of interest rates, and that's on the back of inflation. So let's take a look at the inflation data now. And what did we learn in that inflation data? We saw the annual inflation rate in the US went up by 3.4% in December 2023 from a 5-month low of 3.1 reading in November. Now, that was higher than market forecast of a 3.2% increase as energy prices went down at a slower pace. Meanwhile, prices increased at a softer pace for food, 2.7 versus 2.9, shelter 6.2 versus 6.5, new vehicles 1% versus 1.3, apparel 1% versus 1.1, medical care commodities 4.7% versus 5%, transportation services 9.7% versus 10.1%, and continued to decline for the used car market and truck market, which was disinflationary at negative 1.3% versus negative 3.8%. So that meant that annual core inflation rate also eased to 3.9%, below that critical 4% mark from the previous period, but above expectations of a reading of 3.8%. So compared to November, consumer prices went up by 0.3 of 1%, and that's the most in 3 months and above a forecast of a 0.2% increase. So what did you make of their inflation story, Evan?
So I think you've already highlighted something that I really was using as like the canary, if you know what I mean, the canary in the coal mine about how US inflation was moving and where it sat. And why I say that, what was really core to their overall ridiculous spike that we saw during the COVID years and the post-COVID years was you talked about used car sales and car sales in general. At one point, they were growing at about 15%, not per year, per quarter.
Yeah.
So you saw that overly rapid rate of savings coming out quickly, the fact that you had supply constraints and therefore the only thing you get your hands on was used cars. So the disinflationary numbers there are actually, again, showing that we are getting back into a post-COVID world that actually should start to be described as pre-COVID. We're backing to where that kind of level is, and we want that to happen. We need to basically say COVID was this weird period that we all knew and experienced, but we need to get back down to consistency, need to get back down to the biggest economy in the world doing what it does, which is, again, having inflation hovering around 2%. Now, I do want to highlight, like everybody else, and what we've been hearing is this word sticky, very economic term. The reason it comes is that the inflation data is moderating. As Ben said, there's disinflation, which means we're still getting price increases, but they're smaller than the price increases from the previous month or previous quarter. So that's a good thing, but it does start to get to an equilibrium above where they want it. And that's because we know the consumer is doing reasonably well, and we'll come to that in a minute. We also know, as we spoke just before, GDP is moderating, which is great, but it's still growing at 2.5%, which is good, but slightly stronger than what we were comparing to pre-COVID. So the inflation data is there. The inflation data is moderating to their 2%, which is the FOMC. That's where they want it to be. But there will be hiccups, and that's slightly going on at the moment.
Well, I think if you look at that long-term chart there that you've brought up as well, it's really clear to see that ultimately they've been able to evidence that 2% target range for a long period of time. And you can see that really big spike that's also occurred when it comes to this latest phase of inflation that's rolled through the system. Okay, let's move our attentions now, because obviously that makes a lot of sense in terms of where is all that coming and what did the Fed Reserve do. So we saw that in their January meeting, the Fed Reserve kept the Fed funds rate unchanged at a 23-year high of 5.25% to 5.5% for the fourth consecutive meeting, which was in line with expectations. Now, in terms of their view, they now made it very clear that they want to hold rates at the current level until inflation is moving sustainably towards that 2% target that Evan mentioned. So during the press conference, it was really clear that Jerome Powell, the chair, said it would be appropriate to begin reducing rates sometime this year, but the central bank will continue to make decisions on a meeting-by-meeting basis. And he doesn't think March is a time where he'll see a cut. So how did you read his press conference after the result?
So it needed to happen. And what I mean by needed to happen, so you alluded to the fact that, all of the data points we've just discussed are very much the front end thinking for where the US Federal Reserve is, but all of them are on the same page that we're not at a point yet where cuts are coming. And markets, we love to talk about this, and particularly we're not talking about property here, we're talking about, things like bonds and equities. They are sometimes a little bit irrational and they do tend to get ahead of themselves. We call it the elastic band, where they expand and contract a little bit too hard. So the expectation from the market that we were going to get, and this is what they were saying, we were going to get a rate cut in March, was well and truly too far ahead of where we were supposed to be. And he's not only poured cold water on the March meeting being the first rate cut in the new cycle, he's basically said it's not going to happen. So we saw a repricing in US markets from the expectation that rates would fall from their current band, which is in that 5.5% to 5.75%, down to about 4.75 to 5 by the end of the year. The timing of that has changed. The speed and the drop that it's going to be is roughly the same. But what the market is now saying, instead of it being March, it's going to be June. And that came out of what he talked about. So again, we do need inflation to be probably at 2% in the US to really be at a level that they're comfortable, or at least really falling towards that 2% at a probably faster speed than we're currently doing. They also want to see that employment, which we'll talk about in a sec, is going slightly higher because wages in the US are quite strong still. The employment market's quite tight. So there's still little things that are adding upward pressure in inflation that's just telling them that we're going to cut rates this year, just not yet.
Yeah, I think it's a story of most economies when they're looking at their cutting, and that is really about the employment story, because we know that there's a natural lag that occurs. So let's jump into the unemployment data and see what we learned, over these past couple of months. And even, just as early as last week, we got the non-farm payroll increase by 353,000 jobs in January. So the Labor Department Bureau of Labor Statistics said almost double 180,000 that was predicted by analysts. So the unemployment in the US remained steady at 3.7% in January 2024, and that's unchanged from the previous month and below market's consensus of an increase to 3.8%. Now, the activity rate was also flat at 62.5% last month. Now, in Australia, we call that the participation rate. So for context, and it remains at the lowest level since February of 2023. The number of unemployed individuals decreased by 144,000 to a reading of 6.212 million, whilst the count of unemployed individuals dropped by 31,000 to a reading of 161.15 million people. So that's people employed, I should say, not unemployed. So how did you take that read in terms of, I think Jerome Powell must have known this data when he was talking about basically not going too early on rates.
Yeah, and he's also pointed out very clearly that it was probably a slight aberration in terms of seeing that 350K jobs added. That's well and truly above what they have been averaging over the last 3 rolling month average and the last 6 rolling month average. So they do try and, again, like with everything, try and get it back to what they refer to as core, get it back to a more consistent seasonally adjusted level. So they have been seeing the average monthly employment gain of about 200,000 jobs in the US. So it is quite an aberration to see another 150 above the standard that we've been seeing since about August last year. Again, it shows you just how strong, even with the slowdown in the GDP figures in the US, is being. What we know from this is that there is still a drive to employment. We also know in the US that what we refer to as underemployment, and I'll also talk about this in a minute with Australia, underemployment is those that have a job but are actually looking for more hours of work. And that not only is they got a level of 3.7% on their unemployment, their underemployment is about 6.97%, which is the lowest it's been since the 80s. So that's that tight market we talked to. That's about this. And the reason that matters for the US and for everybody is that if you feel secure in your job, which is what the labour data is showing, your ability to continue to, even in the face of cost of living pressures, still believe you can spend a bit more than you probably usually did, still exists. And you're seeing that in the data. And you're seeing that in the inflation figures that, as we talked about before, that they have moderated to 3.3, 3.5%, but it's just starting to sort of get this little up and down jagged bit where it's just not falling through 3%. And the labour data confirms that again, in the US, they've got a tight labour market, unemployment is low, they're still adding really strong amounts of new jobs into the market. We're not feeling like we have to find more hours. Put that all together, and you can understand why the Fed knows it's got to take its foot off the brake sometime this year, just not yet, because again, there are still signs that things are coming from the COVID years still a little bit too strong for where they want them to be.
You look at, and I think that's a really nice segue into the reverse correlation that happens in consumer confidence and sentiment. So if you think about that, the consumer in the US is saying inflation is starting to ease, and I'm seeing that at the petrol bowser, as they call it over there, and I'm also potentially seeing that in job opportunities. So we did see through the University of Michigan's consumer sentiment for the US soared to a reading of 78.8 in January, and that's the highest since July of 2021. Now, compared to a reading of 69.7 in December and the forecast of a preliminary reading of 70%, that was a big jump. Now, off the back of that, I mean, this is what we're talking about. That's on the back of inflation turning the corner and also the strengthening of income expectations is why we saw a nice confidence spike in terms of the US consumer. Meanwhile, the gauge measuring consumer expectations also surged 75.9 from a reading of 67.4. And the measure assessing current economic conditions rose to 83.3 from 73.3. So talking January and December together, we talked about those, consumer sentiment climbed a cumulative 29%, and that's the largest 2-month increase since 1999 as that recession eventually ended back then. And for the second straight month, all 5 indexes components rose, with a 27% surge in the short-run outlook for business conditions and a 14% gain in current personal finance. If you're talking about a sentiment shift at the start of a new year and effectively a reset, we're seeing it here in the sentiment data. And I think that's, if unemployment remains, or employment remains strong, sentiment high, and the consumers are out there spending, that does put a little bit of pressure on sticky inflation you were talking to earlier.
Yeah, and there's another point to it. Why consumer confidence surveys, for me, and I know for you as well, Ben, are so important. They're future intentions.
Yes.
Right? These are forward-looking ideas, and because the consumer's been asked questions like, where does your family finance look in the next 12 months? Where do they look in the next 5 years? What does your previous 12 months look like? And if you compare that, what does it feel like to now? So when you hear those questions go into these surveys, you can start to understand why they have been this jump, because you and I and all those commentators around there and those in the economic world, we've been talking about 2024 being different to 2023. We're talking about interest rate cuts coming in. We're talking about, the pressure on the cost of living coming out. If you're knowing that that's going to happen and you get those questions, what does the next 12 months look for you? Well, actually, they probably look better than they were in the 12 months that I've just been through, because I know that the pressure on my household budget's going to change. That's what I'm being told. And that's why I'm not surprised to see any of this. I mean, you're talking about, as you said, that 20+% jump over the last 2 months compared to what happened in midway through 2023. If you go back also to have a look at this same data when COVID lockdowns finished, it's actually as strong as that. So it shows that, again, that we have this expectation that 2024 will be different. And that's, again, getting back to our discussion about the Fed and what the Fed has just said to us. They are a little bit aware that if you're sort of, and the RBA here had this idea, your inflation psychology, that's the term they loved using, starts to change because you think you're going to have more disposable income this year, that can actually keep inflation higher. That can lead to that stickiness that they use their terms for and the issue that comes with it. So this is why this is a great thing to see. This chart that we're talking about right now and those numbers at 78.8% on the consumer confidence for Michigan is great, but it does always have a slight double-edged sword. And I want to say it's a very slight one because I'd rather have positive outlooks than negative. But it does mean that maybe we just sort of start to spend a little bit more than we're ready to. And so that's the thing that's going on in the US. We'll talk about this again with Europe and China and all that other stuff as well. And here in Australia, that's what we need to be aware of. And the more stronger central banks out there may use that as an excuse. And let's hope they don't, but just keep this in mind because consumer confidence, as I said, forward-looking indicator, knows what we want to do, knows that we're feeling a little bit more positive. When you feel a bit more positive, you start to relax the purse strings, you start to relax your budgeting. It can lead to increases across the whole economy because if one person does it, but as a group we all do it, that puts that in there.
Look, I think it's fair to say in terms of looking at the data that the US does feel like it's potentially 3 to 6 months ahead of where Australia is.
Yep.
And we've got to remember they had a higher tightening cycle, didn't they? So
Yep.
And that's what we saw surprisingly in the sort of retail sales results. So I want to talk to them next in terms of we saw that the US retail sales soared by 0.6 month over month in December 23, following a 0.3% rise in November. And that was beating forecast estimates of a 0.4% rise. Now, this is the biggest increase in 3 months, led by sales of autos 1.2%, excluding autos, retail sales increased by 0.4%. Now, sales also went up on non-store retailers, 1.5%, clothing 1.5%, general merchandise stores 1.3%. So we're starting to see the consumer spending over there. Miscellaneous store retailers 0.7%, building materials and garden equipment 0.4%, sporting goods, hobbies, musical instruments and books 0.3%, and food and beverages 0.2%. Now, on the other side of the coin, we saw sales decline in health and personal care, negative 1.4%, gasoline stations, negative 1.3%, furniture, negative 1%, electronics appliances, negative 0.3%, and food, services and drinking places were unchanged. Now, finally, excluding auto, gas, building materials and food services, the so-called core retail sales rose a strong 0.8%. And that's the most since July of 2023. So that just gives you an idea in terms of those retail sales. So considering the full 2023 result, unadjusted retail sales increased by a very strong 3.2%, considering, the consumer in the US. I heard stats years ago talking about for every dollar spent in the world, the US consumer makes up about 20% of that dollar. So that just gives you some context in terms of how important the US consumer is to the global economy.
Yeah, and the other part I want to sort of highlight there is the seasonally adjusted part of that. Don't forget, we've just gone through the festive season and the US has had Cyber Monday, Black Friday coming in on November as well. So it does feed into what we've been talking all the way through. So the GDP figures, the inflation figures, retail sales are showing decent numbers, but they're back into pre-COVID levels and more consistent levels. So again, we're not getting these massive fluctuations that we saw in 2022 and 2023 all the way through to about June, where we were getting all over different figures, the speed and power of the change in retail sales. So we're getting back to a more core level. It also showed that actually it was one of the best festive seasons the US has seen. So in terms of the total physical amount of money spent, it was up there. I want to caveat that. Don't forget, US growth in population is rocketing along. It should be more expensive considering that we've had inflation and therefore the price of goods is higher. So take that as you will, because some people try and use that as a negative. It's not a negative. It should be growing every year because inflation, because of population growth. So you need to look at it, as Ben's just described it, from growth per quarter, per month, and per year. And again, what makes me happy and what makes me know that the Fed has done its job, the US is going to land softly, is that we are returning to the norm. We are trying to get away from the 3 years or 3.5 years of COVID back to something that actually looks like, inverted commas, normality. I know that's a horrible, I hate that word, Ben, but it's the right thing to use in terms of where they want it to be. And the reason you take that as a positive is that if we get back to a normality that we had been consistent with before the pandemic, then monetary policy is working, monetary policy can then be eased, and we can get back to doing what the world does really well, which is, making sure that we continue to grow. We're human beings. We always want to improve ourselves, and that's where we're at. And that's retail sales is a great gauge of that.
All right, so let's summarize the key takeaways and then we'll move on to the China data. So the Fed's certainly making sure that inflation is tamed. So they are worried about that consumer spending. So point number one, the consumer is far more confident. So that, again, is potentially good for the economic outlook. But obviously, the other side of the wedge of that, again, is that inflation story. Employment's surprised on the upside there. So we've got to keep an eye on that. And there's a couple of outliers here, which we'll talk to in next month's update. And that is around the Middle East tensions and an escalation of activity going on there. And of course, we can't also go by without understanding that's the US election year. So there's a lot of noise and uncertainty around that. And we obviously need to address that because, economists and economies and investment, we don't like uncertainty. So we'll need to be talking to those two stories as they start to evolve later in the year.